Something remarkable is happening, and here is why it matters. The silver market just experienced what institutional traders call a containment failure. And the panic rippling through banking headquarters isn't about the price hitting 80. It's about what broke on the way up. Let me walk you through what actually happened in the overnight session, because the mainstream financial press is either too compromised or too incompetent to explain the mechanics behind this move. At 2:47 a.m. Eastern, a sell wall positioned at $79, 40 per ounce, containing roughly 87,000 contracts worth approximately $550 million in notional value, simply evaporated, not gradually absorbed through normal trading. Evaporated. Within 90 seconds, that entire position was obliterated by buying pressure that trading desks are describing internally as relentless institutional accumulation. Now, if you've been following precious metals for more than a few years, you know that sell walls at psychologically significant levels aren't random. They're architectural. Banks don't accidentally stack $500 million of paper silver at round numbers. These are deliberate constructs designed to cap momentum, exhaust buying pressure, and signal to algorithmic trading systems that resistance levels are being defended. The $79.80 zone was supposed to be the line. It was marketed that way in research notes. Analysts on financial television spent the past 3 weeks explaining why silver faces significant technical resistance at precisely these levels. That narrative aged about as well as Bear Stearns' equity. This reveals something important. The traditional playbook for managing precious metals prices is encountering something it was not designed to handle: sustained physical demand that cannot be satisfied through the creation of additional paper contracts. Let me explain the distinction, because this is where the entire charade starts unraveling. In normal commodity markets, when price rises, signal scarcity, producers increase output and inventories flow toward the highest bidder. This balancing mechanism keeps speculation from completely divorcing paper prices from physical reality. But silver in 2025 exists in a fundamentally different supply-demand paradigm than it did even 5 years ago. Industrial consumption, particularly from solar panel manufacturing, EV electronics, and grid infrastructure projects, has transformed silver from a monetary metal with industrial applications into an industrial metal with monetary characteristics. That shift changes everything about how the market functions under stress. When a futures exchange can't deliver physical metal against contract expiration because industrial off-takers have already claimed available supply, the traditional pressure relief valve stops working. Creating more paper contracts doesn't solve a physical deficit, it amplifies it. Every short position open to cap the price represents a future delivery obligation in a market where delivery is becoming increasingly problematic. The banks know this, the regulators know this, and now, based on overnight trading behavior, the algorithmic systems are starting to price this in. Let's take this a step further. The composition of who's buying tells you more than the price action itself. According to positioning data updated through yesterday's close, the largest accumulation over the past 11 trading sessions hasn't come from retail speculators or momentum-chasing hedge funds. It's coming from entities classified as commercial hedgers, which sounds boring and defensive until you understand what that category actually includes. Commercial hedgers in silver futures are supposed to be miners, refiners, and industrial consumers protecting against price volatility. They're meant to be natural sellers when prices rise, locking in favorable terms for future production. But the current positioning shows commercial accounts as aggressive net buyers, adding long exposure into price strength rather than hedging against it. This inverts the normal market structure. When the entities theoretically most knowledgeable about physical supply conditions are accumulating rather than distributing, they're sending an unmistakable signal about what they see coming. Either these or industrial consumers panic buying forward coverage because they cannot secure sufficient physical supply through normal channels, or these are banks reclassified as commercial hedgers, liquidating short positions they can no longer defend. Both explanations are bullish, but for different reasons. The first scenario indicates genuine physical scarcity. The second indicates capitulation by the very institutions that have historically managed price through strategic short selling. The data suggests it's both simultaneously. This brings us to the failure mechanics of how price suppression actually breaks. Most people imagine dramatic short squeezes as single catastrophic events. Everyone rushing for the exit at once, prices gapping violently higher, fortunes vaporizing in minutes. That's the Hollywood version. The reality is messier and more insidious. Suppression schemes don't fail through one apocalyptic margin call. They fail through erosion of credibility, then erosion of participation, then finally erosion of the ability to roll positions forward. Here's what that process looks like. A bank holds a large short position in silver futures, betting that price will remain contained. As long as other market participants believe the bank has unlimited ability to deliver physical metal or roll contracts forward indefinitely, that short position exerts gravitational pull on price. It's a credibility trade as much as a financial one. But when doubts emerge, when delivery demands increase, when physical premiums spike, when vaults report drawdowns, the calculus changes. Counterparties start demanding better terms. Margin requirements increase. Rolling positions forward becomes more expensive. The trade that worked for decades starts bleeding cash. At some threshold, continuation becomes more expensive than capitulation. That's the inflection point. And based on what happened overnight, multiple institutions appear to have simultaneously reached that conclusion. The sell wall at $79.40 was undefended because defending it would have required committing additional capital to a deteriorating position. Instead, those contracts were pulled, and price discovery continued upward. What we're witnessing isn't one bank losing a trade. It's the collapse of a coordinated strategy that required collective participation to function. Once the first institution blinks, the coordination unravels. Because if Bank A is quietly covering shorts while Bank B is still selling into strength, Bank B is now providing exit liquidity for Bank A's capitulation. That's not a sustainable arrangement among institutions that increasingly view each other as counterparty risks rather than collaborators. This is the takeaway. The emotional tenor of banking communications around precious metals has shifted from confident dismissal to irritated concern to something approaching quiet desperation. I've seen the internal memos. The language has changed. 6 months ago, research notes described silver as overbought and due for correction. 3 months ago, the framing shifted to elevated but range-bound. Last month, the phrase that started appearing was dynamically evolving supply considerations. That's institutional code for we don't control this anymore. When banks lose control over the narrative framework for an asset class, they've lost the ability to manage price through expectation manipulation. Sentiment shifts from the bank says it's going lower, so I'll wait, to the bank said it would go lower, but it went higher, so maybe the bank doesn't know. That credibility erosion is irreversible within a given cycle. You can't unring the bell. Once market participants realize the emperor's clothes are threadbare, pointing at the tailoring doesn't restore confidence. Now, let me address the question everyone's actually wondering. What happens next? Because $80 silver isn't the end game. It's not even necessarily the midpoint. It's a psychological level that held symbolic importance in a framework that's actively disintegrating. The real question is what happens when institutions that built business models around cheap, readily available silver confront a market where silver is neither cheap nor readily available. Let's examine two scenarios, not as predictions, but as frameworks for understanding the forces in motion. Scenario A, managed retreat. In this version, banks recognize the game is over and execute strategic withdrawals from short positions. They take losses, substantial ones, but they preserve institutional viability by cutting exposure before true catastrophe. Price rises significantly, perhaps to $120, $150 range over 6 to 9 months, as accumulated short positions are unwound in semi-orderly fashion. Volatility spikes, but markets continue functioning. Physical premiums stay elevated but available. Industrial users grumble and adjust, but supply chains adapt. The Fed and regulatory bodies tacitly allow this repricing because attempting to suppress it would require interventions that risk exposing the entire facade. Silver finds a new, higher equilibrium reflecting genuine supply-demand fundamentals rather than managed perception. This is the optimistic scenario. It assumes rationality, coordinated retreat, and acceptance of losses. It assumes institutions prioritize survival over pride. Scenario B, disorderly unraveling. In this version, banks refuse to accept reality until forced. They double down on short positions, believing they can outlast physical buyers if they just commit more capital. This works until it catastrophically doesn't. A major industrial off-taker, let's say a solar manufacturer or defense contractor, can't secure necessary silver supply through normal channels and begins buying futures with intention to demand delivery. The exchange, unable to source sufficient physical inventory, issues delivery delays or force majeure declarations. This instantly destroys confidence in paper silver as a proxy for physical metal. Premiums on physical silver explode to 30%, then 50%, then 100% over spot. The paper and physical markets decouple entirely. Banks holding short positions face margin calls they cannot meet. Counterparty defaults cascade. The CFTC steps in with emergency position limits or trading halts. Congressional hearings follow. Criminal investigations begin. Silver prices in this scenario could spike to $200, $300 as paper market sees, then collapse back to $100, $120 as emergency measures force settlement at arbitrary levels. Trust in commodity futures as functional markets evaporates. Industrial users hoard. Mints suspend retail sales. The entire architecture of precious metals price discovery enters crisis mode. This is the catastrophic scenario. It assumes institutional rigidity, regulatory capture, preventing timely intervention, and cascading failures, overwhelming containment efforts. The actual outcome will likely contain elements of both. Some institutions will retreat strategically, others will cling to positions until forced out. Regulators will intervene, but probably too late, and with measures that create additional distortions. Physical and paper markets will experience periods of dislocation without fully decoupling permanently. Volatility will spike to levels that trigger circuit breakers and emergency protocols. This makes all the difference. Which scenario predominates depends primarily on one variable: how quickly institutions recognize that the cost of continuation exceeds the cost of capitulation. And that calculation is happening right now in real time in trading desks across New York, London, and Zurich. The overnight price action suggests at least some institutions have already made that determination. The sell wall failure wasn't a technical glitch or a retail buying frenzy. It was the visible manifestation of institutional repositioning, large players pulling bids, reducing exposure, acknowledging that defending arbitrary price levels has become prohibitively expensive relative to simply stepping aside and allowing repricing. But here's where it gets genuinely interesting. The banks aren't the only players reassessing. Central banks, particularly those outside the US-European axis, are watching this carefully. If silver's rise reflects genuine physical scarcity rather than speculative fervor, it signals something much larger about commodity markets broadly. It suggests that the extended period of low commodity prices maintained through financialization and derivative manipulation may be ending, not because of policy changes or regulatory reform, but because the physical world is reasserting itself against paper abstractions. You cannot print silver, you cannot legislate it into existence. You cannot hold a committee meeting and decide there should be more of it. Global production is roughly 1 billion ounces annually, a figure that has remained relatively stable despite price increases because high-grade deposits are largely exhausted and silver is primarily mined as a byproduct of copper, lead, and zinc operations. Demand, meanwhile, has structurally increased due to electrification, renewable energy buildouts, and industrial applications where silver's unique properties have no adequate substitutes. This is basic physics running headlong into financial engineering. For years, financial engineering won because markets believed in its supremacy. Derivatives were treated as functionally equivalent to physical inventory. Paper claims were accepted as good as metal in hand. But physical scarcity has a way of clarifying distinctions. When industrial users need actual silver atoms to manufacture solar cells or electrical contacts, futures contracts won't suffice. They need deliverable metal. And when deliverable metal becomes scarce relative to paper claims, the entire structure of financialized commodity pricing faces existential questions. Let me give you specific context for why the timing of this matters. The global solar installation pipeline for 2025-2027 represents the single largest three-year demand surge for silver in history. We're talking about an incremental 400 million ounces of consumption beyond baseline industrial and investment demand. That's roughly 40% of total annual mine supply dedicated just to solar applications. Add in accelerating EV production, 5G infrastructure, weapon systems, and water purification, and you're looking at industrial demand alone potentially exceeding total global production within 18 months. In a normally functioning commodity market, price would rise to incentivize increased production and ration demand among less price-sensitive applications. But silver's production profile does not respond quickly to price signals because 70% comes as byproduct from base metal mining. You can't just open a silver mine in response to higher prices. You're actually opening a copper or zinc mine that happens to produce silver. The lag time is measured in years, not months. This creates a window where demand exceeds supply, inventories drain, and price must rise to clear the market. The only question is how high and how fast. And that determination is being made right now through the interaction of physical buyers who need metal and paper sellers who have historically controlled price. What happened overnight suggests the paper sellers are losing. This tells us something important. The financial media's framing of this move as silver rallies on inflation fears, or as precious metals surge amid banking concerns, fundamentally misses the mechanism. This isn't sentiment-driven speculation. It's the manifestation of physical market tightness, overwhelming derivative market manipulation. The inflation narrative, the banking crisis narrative, those are convenient explanations that avoid confronting the uncomfortable reality that commodity futures markets have become divorced from the physical commodities they ostensibly represent. When that divergence becomes too extreme, reconciliation occurs. Always. The only variables are timing and violence. Gradual reconciliation looks like steady price appreciation as paper positions align with physical reality. Violent reconciliation looks like the overnight evaporation of sell walls and institutional capitulation cascades. We're watching that reconciliation accelerate. Now, I want to address something you're probably thinking. If this is so obvious, why aren't more people talking about it? Fair question. The answer involves understanding how information flows through financial media and whose interests those flows serve. Major financial news outlets derive substantial revenue from banking sector advertising and institutional access. Their analysts rely on relationships with bank research departments for information and career opportunities. This creates structural bias, not conspiracy, but aligned incentives toward presenting banking favorable narratives. When silver rises, despite banking sector research calling for consolidation or correction, the media faces a choice. Question the bank's analysis or question the market's rationality. Guess which frame protects relationships and advertising revenue? So you get stories about retail speculators pushing silver higher, or technical factors driving momentum, explanations that preserve banking credibility while acknowledging price movement. The reality of institutional capitulation, physical shortage, and derivative market failure doesn't fit that frame. It implies incompetence or malfeasance at institutions that are supposed to be sophisticated and well-regulated. It raises uncomfortable questions about regulatory oversight and market structure, so it gets excluded, not through editorial conspiracy, but through institutional inertia and incentive alignment. This is why independent analysis matters. This is why examining actual positioning data, delivery statistics, and vault inventories provides signal that narrative-driven financial journalism cannot. The data doesn't care about advertising relationships. It doesn't worry about access. It just reflects what's actually happening beneath the narrative overlay. And what's actually happening is that silver's price is attempting to reconcile with silver's scarcity, while institutions built around the assumption of unlimited paper substitutability scramble to adjust before their exposure becomes catastrophic. You're witnessing a phase transition in real time. Not a trend, not a rally, a structural shift from one market regime to another. The previous regime operated on the assumption that paper silver adequately represented physical silver for all practical purposes. That assumption is failing. The emergent regime will operate on the recognition that physical metal and financial derivatives are related but distinct assets with different risk profiles and price discovery mechanisms. During the transition between regimes, volatility spikes, old relationships break down, and institutions positioned for the previous regime face losses, while entities positioned for the emergent regime accumulate gains. That's not prediction. That's description of what happens during any phase transition, in markets, in physics, and complex systems generally. The banks panicking at $80 silver aren't panicking because 80 is a scary number. They're panicking because $80 represents the failure of containment strategies that were supposed to prevent exactly this outcome. It's the visible confirmation that they've lost control over price discovery. And if they've lost control over silver, the implications extend to gold, platinum, palladium, and potentially the entire complex of commodities, where financialization was assumed to have permanently subordinated physical reality to paper abstractions. So when you see headlines about silver hitting $80, understand that the price level is the least interesting part of the story. The mechanism behind that price, the failure of institutional suppression, the emergence of physical scarcity, the capitulation of coordinated short sellers, that's what actually matters. That's the story with implications that extend far beyond one metal's spot price. This is playing out faster than most institutions anticipated, which is why you're seeing panic rather than orderly adjustment. They expected more time. They thought they could manage this transition. The overnight price action suggests they were wrong. And here's the part that should genuinely concern anyone paying attention. If institutions miscalculated this badly on silver, a relatively small market with limited systemic importance, what else have they miscalculated? What other assumptions about infinite derivative substitutability are about to face reality testing? What other managed markets are approaching their own containment failures? These aren't rhetorical questions. They're the natural extensions of what overnight trading action revealed. The architecture of financialized commodity control is showing cracks. Silver was just the first market where physical scarcity exceeded paper manipulation capacity. It probably won't be the last. Watch what happens next. Watch whether institutional media acknowledges the actual mechanics or continues spinning sentiment narratives. Watch whether regulators intervene to support failing short positions or allow price discovery to continue. Watch whether physical premiums compress or expand from current levels. Those indicators will tell you whether scenario A or scenario B is unfolding, managed retreat, or disorderly unraveling. Either way, the sell wall just failed, and that failure tells you everything about who's actually in control of this market. It's not the banks anymore.